Hello there and welcome to Project Business Basics, the podcast designed to give some information about how financial markets work and various accounting practices in order to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our podcast. So in our last episode, we talked about fundamental analysis versus technical analysis. And fundamental analysis is evaluating if a company is a good investment, and it's looking at the business, trying to determine whether it's a good business that they're investing in. And today we're going to talk about the other type of analysis, which is technical analysis. And for technical analysis, you statistically analyze stock price movements to try to predict what might happen in the future. And that way you can make small profits based on that. Now, a key difference to note when talking about fundamental analysis and technical analysis are some of the verbs used when discussing them. So we have two verbs, trading and investing. Now, trading is buying and selling stocks and seeing them as short-term profit makers. So this is a stock that you might buy within a day and then sell a few hours later, or a few days later, or maybe even 1 week or 2 weeks later. You're not keeping those stocks for long. You're mainly focused on getting that profit over the short term. Whereas investing is the verb commonly used to refer to buying stocks for months or years on end. And investing is mainly the verb that's used with fundamental analysis, and trading is the verb mainly associated with technical analysis. Now let's dive deeper into technical analysis. We know that the stock market is a collection of human activity, and on Project Business Basics, we've discussed how stock prices are pretty much set by the principles of supply and demand, where whenever you have more traders who are willing to sell stocks, then that drives the prices of the stock down because you have a larger supply of stock available. Therefore, then you have a lower stock price. And the opposite of that is when you have a low supply of stock and you have traders who are wanting to get into that investment or into that deal, and that ends up driving prices higher. Now, when we talk about supply and demand being the factors that drive stock prices, especially in the short term, then we know that it's dependent on human activity. And with human activity comes a lot of emotions. And that's why if you look at the daily market prices or how the stock market does as a whole each day, you see some days where the stock market goes up by a lot and some days where it falls a lot. And you see these wild daily swings happening, and these daily swings are simply reflecting the fact that human emotion plays a big factor in the daily movement of the stock market. And so what technical analysis looks to do is look at those behaviors, look at human behavior and say, you know what, human behavior is what's causing the stock market to move up or down. As a whole, for an investment, that's not ideal. That could hamper an investment. So what technical analysis looks to do is looks in the past time periods, and it says, look, this data has human emotion intertwined in it. And human emotion is going to play a factor in the stock price tomorrow. So let's use that data of human emotion from before, and let's try and predict what's going to happen tomorrow or in the near future. And that, simply put, is what technical analysis is. And we've seen an increase of the prevalence of technical analysis used by companies or used by individuals over the past 20, 30 years. And that is because of the digital age. With computers, technical analysis has really blossomed because with computers you can perform highly complex mathematical calculations for technical analysis, and it's also more accessible to people, which is why technical analysis has really gained in popularity recently. So for today's episode, what we're going to do is go over some commonly used indicators regarding technical analysis. And the first one that we're going to look at is moving averages. And moving averages are exactly what they sound like, and they're the sum of a stock's price over a period of time. And the common lengths used for moving averages are 10, 20, 50, 100, or 200. You may have noticed after I said 200, I didn't put a length of time in. And that's because technical analysis can look at stocks over a wide range of time periods. I have seen some forms of technical analysis that try to examine stock movements every 30 minutes, or every 1 minute, or every 1 day. And as goes the pattern, technical analysis can be applied to a shorter range of time or a longer range of time. Now, traditionally with moving averages, you tend to see the moving average graph plotted against the stock price. And the general trend that follows then is that the stock price, whenever the stock price is above the moving average line, then it's an upward trend. Whenever the stock price, though, falls below the moving average line, then that's a hint that the stock is in a downward trend. Now, two notes to distinguish about moving averages are: one, you have something called simple moving averages. And simple moving averages are the normal moving average you think about. But then the second type of moving average is called an exponential moving average. And if you know what a weighted average is, where it gives weight to certain data points, well, exponential moving averages work in the same way, because they give weight to more recent prices. So the difference between an exponential moving average and a simple moving average is an exponential moving average is more likely to take into account the most recent price activity of the stock. Now let's look at an indicator called the moving average convergence divergence. And that's a mouthful, so it's commonly known in the industry as MACD. And MACD is equal to the 12th period exponential moving average minus the 26th period exponential moving average. And with MACD, you have something called a signal line and the MACD line. Now the MACD line is a plot of the MACD of a stock over a period of time. The signal line it's getting meta here. The signal line is a 9-day exponential moving average of the MACD. And the signal line is often plotted against the MACD line, and it's used to find buy and sell points. Now this can get confusing, but it's best to try and visualize this with an image of the MACD. And an image of the MACD would look something like a graph of time on the horizontal axis, and on the vertical axis you would have the exponential moving average. And you'd have two lines then going across the graph. You'd have the MACD line, and you'd have the signal line. And the signal line is a form of the MACD. And what you'd look for, you have two lines on this graph. You'd look for points where the MACD crosses the signal line, and that can be used to indicate buy and sell points. Now let's look at this indicator called the relative strength index. And a lot of traders, especially traders who are new to technical analysis, they really like this one because it's very simple to understand. Simply put, the relative strength index is a graph that indicates if a stock is overbought or oversold. And how it looks like is it has on the horizontal axis time going across the bottom, and on the vertical axis it has numbers. These numbers are usually separated by tens. They'll go from 0, 10, 20, 30, 40, and they'll usually go to about somewhere between 80 and 100. And what this graph is looking for is it sets these dotted lines at the vertical axis of 30 and 70. And you have a horizontal line that's perpendicular to this axis, to this vertical axis at 30 and 70. And then you have a plot. You have a plot of a line running along that graph. And whenever this line goes over 70, then that indicates that the stock is overbought. And if a stock is overbought, that likely means that its stock price is going to fall. And similarly, you have a dotted line at 30. And if the RSI line falls below 30, then that indicates that the stock is oversold, which means that it's been sold too much, so it's likely going to be bought up in the near future, which indicates a price change in the upward trend. So relative strength index can be used to signify the short-term movements of a stock. And just like you have the relative strength index, or the RSI, you have another indicator called the stochastic oscillator. And the stochastic oscillator works in the exact same way as RSI, except instead of measuring whether or not a stock is overbought or oversold, it seeks to measure the momentum of a stock. And the stochastic oscillator is set up exactly like the RSI. You have time on the horizontal axis, numbers by tens on the vertical axis, and your bounds in this case are the numbers 20 and 80. So when you have this line going along the graph, and if the line crosses 80, that suggests that the stock then, its momentum has gone too high and it's going to fall. And similarly, if the stochastic oscillator line falls below 20, then that suggests that the stock's momentum has gone down too far and it's going to come back up, indicating it's a buy point if it's below 20. Now, another big indicator we're going to look at are these indicators called candlesticks. And the way candlesticks work, you have a vertical rectangle with a line going through the top of the center of the rectangle and a line going through the bottom of the center of the rectangle. And every point of this rectangle is a measure. Now you have two types of rectangles. You have either a green rectangle or a red rectangle. And a green rectangle indicates a positive move for the time period, where the bottom edge of the rectangle is the stock price at the open of the period. The top edge of the rectangle is the close of the stock price in the period. The line going through the top of the rectangle is the stock's high point over the time period, and the line going through the bottom of the rectangle is the low point of the stock. And that is for a green rectangle. Whereas for a red rectangle, you switch the open and close, where the bottom edge is the close for the stock over the period, and the open is represented by the top of the rectangle. And traditionally with green and red, those are the colors used, but sometimes you might also see them used as green is to white, as red is to black. So what are these rectangles or these candlesticks telling us? Well, what we do is we plot the pattern of these candlesticks over time. And the visual patterns formed by the candlesticks signal price direction. And these candlestick patterns are actually derived from Japanese rice trading patterns of the 1800s. Now, a key takeaway to note about candlestick patterns are that their effectiveness decreases 3 to 5 candlesticks after each pattern. So let's take a look at some possible candlestick patterns. First, we have a 3-line strike. And a 3-line strike can signal price direction, either bearish or bullish, either upward or downward. And the way a 3-line strike pattern works is it has 3 successive candles going in the same direction. So it could be 3 green candles going progressively up, and then followed by one opposite direction candle encompassing the previous 3. So those 3 progressively rising green candles could then be followed by a much larger red candle that is large enough to fit all 3 of those previous candles. And that is known as a 3-line strike. And in that situation, if it was 3 rising green candles followed by a large red candle, then that would suggest a bearish move. Whereas vice versa, if you had 3 successively decreasing red candles followed by one much larger green candle, that would signal a bullish move. Now, another pattern that's there is the pattern called the evening star. And the evening star is a bearish signal. What it is it is a large green candle followed by a red candle that sets a relatively new high, followed by a then lower red candle. And this pattern ends up forming the shape of a star, where it goes from green to a red candle that's slightly higher, followed by an even lower red candle, and that signals a bearish move. Another pattern is called the abandoned baby pattern. And the abandoned baby pattern is a bullish pattern, where you have one red candle that produces lows. You have another red candle after that, but it's narrower, but it produces new lows, followed by one green candle. And this abandoned baby pattern suggests then that the stock's price is going to go up in the near future. Next up then we have the engulfing pattern. And this engulfing pattern can be used for either a bearish or a bullish move. And this one is a little easier to identify because you just have to remember two candlesticks, where you have one candlestick and then you have the opposite colored candlestick that is engulfing the entire body of the previous candlestick. So you could have one red candlestick and then you could have a much larger green candlestick right after it. But that green candlestick has to be large enough to be able to fit that previous red candlestick in its body. And this engulfing pattern then is going to suggest the price movement to be, is going to suggest the future price movement to be whatever the second candlestick is. So if we had red followed by a larger green, then that would suggest bullish move followed by price movement upwards. Whereas if we had green, then followed by a much larger red, that would suggest a red candle, that would suggest bearish moves in the short term. Now our final indicators we're going to look at are called support and resistance lines. And support and resistance lines are horizontal lines drawn along the graph of a stock over time. And support and resistance lines require you to answer two questions. The first is, what price areas is the stock consistently falling to? If you notice a stock go up, then fall down, and then you'll notice in most cases that the stock's price is going to hover around a certain range. And similarly, you'll notice that whenever a stock shoots up, it'll at first struggle to get past a certain range of prices. And those form your support and resistance lines, where resistance is where the stock price consistently struggles to get past, and support is where the stock price falls to as a safe haven whenever it falls. And what support and resistance lines can do is, if you notice a stock reach its resistance point and then fall, if you know where the support is, then that's likely a good indicator that the stock price is going to fall to its support. So that's one example of how support and resistance lines might be used. I hope you've enjoyed listening to this episode. If you want to learn more about stocks and investing and how to get in the right mindset, then I encourage you to check out our website, businessbasics.online, where you'll find our newsletter, podcast, and our blog. And if you sign up for a newsletter, you'll be able to get interesting business articles sent to your inbox. Also, if on our blog, you'll be able to find our book reviews for particular books or our discussions over recent business news. If you had any thoughts about technical analysis or you have any suggestions about future show ideas, then reach out to us on Instagram and Twitter. Our username is at PROJBIZ Basics. If you liked that episode, then go ahead and leave a like below and also subscribe to our channel. All the links that I mentioned are listed below in the description. I'm Archit Janarkar. This is Project Business Basics. Thanks for listening.